Good morning and welcome to our Ashworth Wealth Weekly Market Update. My name is Scott Thomas. I came across some very interesting numbers over the last few days. I want to talk about consumer spending, but I also want to talk about interest rates and how interest rates are not only affecting us now, but where we've been. We're going to kind of take a walk down memory lane. We're going to talk about interest rates, where they have been, where they're at now, and what we think is going to happen later on down the road. And then also, how does it affect us? Because interest rates are a big part of our economy, and it's one of the levers that the Fed has that they can pull to either get the economy moving or slow the economy down if we have inflation. And we've seen these wild swings over the last couple of years. The first thing I wanted to share with you, it's obvious our economy is very consumer driven. And so we are constantly watching consumer spending and what consumers are spending their money on and watching consumer confidence. That is a big indicator of how our economy is doing and whether we're a healthy economy or not. A couple of things I wanted to share with you. This is a chart where it goes through month by month and comparing this year to years past of where we are spending our money and how and what the trends are. And what's very, very interesting here is our year over year total spending, which is the top column there across the top. We are actually up about 4.9% for the year. So we're actually spending as American consumers right now about 4% or almost 5% more money this year than we did last year. What's very interesting though is where the spending trends are going. So retail spending is up, healthcare is way up, but then you go down and you go to the bottom of that chart, and what's very, very interesting is airline spending is way down, and gas stations, which I was very surprised, are way down. I also read an article the other day that Las Vegas, as of right now, and I can't remember, this is going back a week or so, but I read an article that talked about the vacancy rates in Vegas are as high as they've been in a long time. And they're speculating that, costs have gone way up, or excuse me, the cost of rooms has gone way up. There's a number of different reasons, but it's very interesting to see that airlines, lodging, those kinds of things are down right now. A couple of reasons for that. Number one, I think there's still a lot of questions out there about tariffs. We've talked a lot about tariffs over the last few months. That is coming to a head. There's been some agreements that have been announced in the last week or two. I think there will be more agreements to come out here in the next few weeks, but that's going to continue to drive consumer confidence, is what's going on with tariffs. Now, speaking of tariffs, um, companies seem to be very apprehensive about raising costs on products, even though they've been affected by tariffs. It's very apparent that those companies are very hesitant to pass those increased costs onto the consumer, especially when we look back and over the last couple of years, we've had very high inflation. Companies are very hesitant to raise prices. So it's going to be very interesting to see how that balances out over the next few months. But just to give you an idea, since we went through COVID and the economy is still in pretty good shape, and balance sheets of companies remain healthy. But a couple numbers that jumped out to me: household net worth has grown by $50 trillion since the beginning of the pandemic, which I thought was an interesting number. Also, as of right now, consumers have $9 in assets on average for every dollar of debt or every dollar of liability. So we're going to continue to watch that as well. So overall, things are fairly healthy right now. So what should we be watching for as investors going forward? Well, one thing that we're watching very closely are the job reports and unemployment. The labor market. As of right now, and there was a big fight in Washington last week that the jobs report that came out, they actually adjusted it down. They were using numbers that the president wasn't very happy about. They actually adjusted those down. So the labor market looks weaker right now than it was expected to look. Okay, so what does all that mean? Well, if the labor market is getting weaker, okay, so we are not at full employment or there's not a lot of hiring, typically that is a reason why we want, or why the Fed would lower interest rates to start stimulating the economy. Okay, and I'm going to go through that here for just a minute and kind of explain why. But as of right now, our annual inflation rate is 2.7%, and we've been there now for a few months in a row. So it looks like inflation is under control. So the battle now is the White House would really like the Fed to cut interest rates to stimulate the economy, but on the other hand, the Fed does not want to cut rates too fast, so we go back into inflation. So there's this kind of a balancing act going on back and forth, and I think we're going to continue to have that fight in Washington. But I want to kind of take you down a walk down memory lane. I want to go back and kind of give you an idea of where interest rates have been over the last 10 years or so. This is the Fed funds rate. So this is the rate that the Fed loans money to the banks. Then the banks take that money, increase it, and then that's what they loan out for car loans, home loans, consumer loans, credit cards. It affects just about everything that we do in the financial markets. Okay, so in 2015, the Fed funds rate was 0.25%, 16.5%. Now, these are the days where you could go out and get a mortgage at 2.9% or 3%. That's why, because the Fed funds rate was so low, so banks would mark it up a little bit and then loan that money back out. That's also a very good rate. 17, it was starting to inch up, 0.75%. 2018, 1.5. 2019, 2.5%. 2020, 1.75%. 2021, 0.25%. 22, 0.25%. 23, this is where we got into trouble, is it went from 0.25% for the Fed funds rate. In 23, it went up to 5.5. Since then, in 23, 24, and now in 25, the rates have come down maybe just a little bit, but right now we're sitting at about 4.5. So it's come down a little bit, but we are 4 or 5% higher on the Fed funds rate than we were just a few short years ago. So those 3% mortgages are now at 7 and 8, or 6 or 7 or 8. So it makes it awfully hard to buy a car, makes it harder to buy a home, makes the credit card expenses are higher. All those things are higher. What the White House is hoping is they'll decrease those interest rates, make it easier to borrow, which stimulates the economy. Okay, just one last thing I came across. I thought this is a very good explanation of why investors, or why we as investors, should care about interest rates. I'm just going to go ahead and read, I thought it was a very good summary. The path of interest rate has real life implications for people, impacting everything from the amount you pay for a car loan to the rate you're charged on your credit card to your retirement planning. Interest rates have an impact on investors too. Lower interest rates tend to boost bond prices and push bond yields down. Rate cuts are generally considered good for the stock market. We would agree with that. Lower interest rates stimulate economic growth, which boosts corporate profits and earnings, reduce borrowing costs, which improves profit margins and makes stocks more attractive relative to fixed income alternatives. Tech stocks and small cap stocks often benefit the most from low interest rates, considering these companies are more reliant on future earnings expectations and can borrow money more cost effectively when rates fall. That is something that we have seen over the last 3 or 4 years. If you go back, the small companies, the small value companies, the small international, those typically have been the highest performers on average over the last 60 or 70 years. That has not been the case over the last 4 or 5 years as interest rates have gone up. So as interest rates as they continue to remain high, those asset classes have struggled, and hopefully those will turn around as interest rates go down. Anyway, hopefully this was some good information. As always, we've had some very good suggestions on topics that you'd like covered. If there's something you have a question about, please get a hold of us. Please send us an email, whatever. We enjoy doing these, but we really would like to answer individual questions as you have those. Please feel free to pass this along. We appreciate all that you do for us, and we'll see you again in a couple weeks. Thank you. Bye.